So today's policy was in many ways quite as expected. The RBI didn't cut rates, which was our expectation, and they also maintained the stance of monetary policy at neutral instead of reversing it back to accommodative, which is again in line with what we had expected. What did come as a little bit of a surprise though was that this was not a unanimous decision. This is the first instance since the MPC has been formed that the rate decision hasn't been unanimous. So I think that's really something very interesting. While the MPC has reduced its assessment for inflation in H1 and H2, they maintain the earlier expectation that inflation will slope up, and that's something that we agree with as well, that H2 inflation, particularly as the base effects go away, would be significantly higher than what it would be in H1, although it's not likely to rise to an alarming level. And of course, the MPC's assessment has been made ignoring the impact of the HRA impact based on the 7th Central Pay Commission's recommendations, the timing of which is still uncertain. The other thing is that the GVA forecast has been lowered by 10 bips for FY18, but that's also in line with the fact that the GVA forecast assessment for FY17 has been lowered by 10 bips by the CSO as compared to their earlier estimate. So the rebound in growth that the MPC is expecting is still a fairly solid 70 bips from FY17 to FY18. That combined with the slope up in inflation that they're expecting, and the fact that they're not very convinced that the drivers of low inflation right now would really persist in the face of the inflation risks which are still there. Overall, these are the factors that really culminated perhaps in the MPC's decision to stay put. But with the tone being softer than at least the April policy document, and certainly much softer than the minutes of the April policy meeting, I think a little bit of space, the possibility has opened up for one rate cut of 25 bips down the line.